Markets under pressure as the conflict in Iran enters its third week. Investors closely watching oil disruptions in the Strait of Hormuz, even as inflation inches higher and AI continues to spook software investors. Joining me now, Oakmark Fund Portfolio Manager and CIO Bill Nygren. Bill, market has lots to digest right now. We just ran through some of those issues. How do you think about investing when bombs are falling?
Well, at Oakmark, what we're trying to do, Jack, is look out 5 to 7 years in the future, estimate what a company is worth then, and buy at a big discount to that today. So the events that we're talking about, as terrible as the war is, it might affect 1 year's cash flow a little bit, doesn't really alter the 7-year business value very much.
Let's hope we're not still talking about the Iran war in 7 years. Very briefly, can you describe how you approach value investing? In some ways, people attribute you to, they say you've rewritten the playbook of value investing.
Oh, that's very kind of them. What we do at Oakmark is, as I said, we try to estimate what a business is worth, and we'll look forward 5 to 7 years. And we aren't tethered to PE ratios and price to book ratios like so many value investors used to be, because we think so much of the value today is in intangible assets. So we kind of redo GAAP accounting to Oakmark accounting. And on our numbers, we're looking for companies that are selling at a discount, where we think they're well managed and will grow value over time.
So the largest holding in your portfolio is actually coincidentally kind of a classic value stock, but has also benefited dramatically in recent months from what's happening globally, and that's ConocoPhillips. Why do you like that company?
Yeah, more of our portfolio today is classic value than it's been in a long time because of this divergent market where high PEs keep going higher and low PEs aren't really participating. What we like about Conoco, if oil is about $70 a barrel, and it's higher than that today, but the futures market has it there in about a year, at that number, ConocoPhillips is at about 9 times earnings and is returning almost all that cash flow to shareholders primarily through repurchase. And what we like about the management mentality there is if they don't think they have a competitively advantaged way to reinvest capital, they give it back to the shareholders.
Speaking of which, they're going to be sitting on some great cash flow numbers in the near future. Do you expect a special dividend or something like that from Conoco?
I doubt they'll go a special dividend route, but they might increase their share repurchases. Sure, with oil at $100 a barrel, the earnings for the next few months will be much higher than long-term trend.
Another company that would not have been a standard value play, Salesforce, and that company's under a lot of pressure from the so-called SaaSpocalypse. How are you thinking about Salesforce?
Yeah, I think if you just look at the metrics, Salesforce looks like a value stock today. They're trying to buy back about 25% of the company. They're selling at a low teens PE ratio. If you compared Salesforce to the banks a couple of years ago, Salesforce probably sold at twice the PE multiple. Today it's about the same. So we look at it as a high quality business. It's embedded into most of the companies that are customers in a way that I don't think AI is going to displace it. In fact, we think AI is going to help increase the growth rate at Salesforce.
It's going to be fascinating to watch and see how this all plays out, if these companies can either benefit from AI or get clobbered by it. But I want to move on to a very different kind of company, Keurig Dr. Pepper. What's the appeal there?
So it's a beverage company, both the Dr. Pepper side and the coffee side. And they're going to be splitting into 2 parts, hopefully by late this year. Our argument is that we think the soft drink side of the business deserves to be priced pretty similar to Coca-Cola. It's growing faster. If you put that multiple on it, you basically get the coffee business for free. And we think that's a nice business.
Alrighty. Real quick, Zimmer Holdings, its big competitor is Stryker. Stryker looks a lot more successful recently, and is that the appeal of Zimmer?
Absolutely, and that's what we see in a lot of stocks in the market today. Zimmer is not as good a company as Stryker is. And it's typically sold, Stryker's typically sold at about a 50% PE premium. Today that premium is more like 150%. Zimmer sells at a single-digit multiple. They've got some organic growth now, most of the capital coming back to shareholders. So the low PE really entices us there.
We do have to go. Would it be fair to say that most of these companies are pretty inflation resistant?
I think so. When you've got a strong brand, it gives you a lot of protection and ability to pass through inflation.
All right. Bill Nygren.
And Conoco actually benefits from it.
Exactly. Thank you so much, Bill. Great to have you here.
Thank you.
AI is moving at breakneck speed, and software stocks are in the crosshairs, as we said, but one tech giant may be better positioned than the rest. That's next.